Have you ever looked at a company's financial report and thought, where do I even start? Because financial analysts do not just read statements, they decode the stories hidden in numbers. Hi everyone, welcome back to InfoCraze, your channel to learn accounting and finance in a smart and simple way. In today's video, I will show you how professionals analyze financial statements. If you are new here, make sure to subscribe and press the bell icon so that you never miss a video that will help you to grow in your finance career. Now, let's get started. As we know, for any company, the three financial statements that matter the most are profit and loss account, balance sheet, and the cash flow statement. Profit and loss account shows how much it earned or lost. Balance sheet is a snapshot showing what the company owns and owes. Cash flow statement gives a picture of how cash actually moved. Let's get some more information about these crucial statements, starting with the profit and loss account. A profit and loss account, also called an income statement, is a financial statement that shows a company's performance over a period of time, usually a year. It tells us whether the company made a profit or a loss during that period. Let's take a sample profit and loss account of ABC Limited. The key components are revenue or income, which is the money earned from selling goods or services. Then we have the expenses, which is the money spent to run the business, depreciation, and taxes. Finally, we get the profit, which is the difference between revenue and expenses. In case the expenses are more than the revenue, then the difference provides the loss amount. Analysts review the profit and loss account to check the performance of a company. They look for the growth trends to check whether revenue is rising every year. They also look at profitability to check whether the margins are stable or shrinking. If revenue and profit both are growing steadily, that's a healthy sign. Then we need to look into the expense control, which is to check whether the costs are increasing faster than sales. One should compare 3 to 5 years data while reviewing the profit and loss account, as one good year can hide a weak trend. Once the profit and loss account is checked, analysts review the key ratios. Let's find out some of the important key ratios from our sample profit and loss account. The first one here is gross profit ratio, which is equal to gross profit divided by sales revenue multiplied by 100. Now what is gross profit? Gross profit is equal to sales revenue minus cost of goods sold. If we put the numbers from our sample profit and loss account, that is 15 lakhs of sales revenue minus 9 lakhs cost of goods sold is equal to 6 lakhs. Thus, gross profit ratio will be 6 lakh divided by 15 lakh multiplied by 100, which is equal to 40%. Thus, the company earns 40 rupees gross profit on every 100 rupees of sales, which highlights a good efficiency in production or purchase costs. Next one is operating profit ratio. Operating profit ratio is equal to operating profit divided by sales revenue multiplied by 100. Now what is operating profit? Operating profit is also called EBIT, that is earnings before interest and taxes, which is equal to gross profit minus operating expenses minus depreciation. Thus, it gives us 6 lakhs minus 2,50,000 minus 1 lakh, which is equal to 2,50,000. Thus, operating profit ratio in our example is 2,50,000 divided by 15 lakhs multiplied by 100, which is equal to 16.67%. Thus, about 16.67% of sales remain after covering direct and operating costs, which is efficient but can improve. Then we have the net profit ratio, which is equal to net profit divided by sales revenue multiplied by 100. Now, by putting the values of net profit and sales revenue, we get a percentage of 9.33%. This means company retains 9.33 rupees as net profit for every 100 rupees sales, which is a decent profitability after all the charges. Then we look at the interest coverage ratio, which is equal to EBIT divided by interest expense. As we know, EBIT, that is earnings before interest and taxes, is equal to operating profit, which is 2,50,000. Therefore, in our example, the interest coverage ratio will be 2,50,000 divided by 50,000, which is equal to 5 times. This means the company earns 5 times its interest expense, which means the company has a strong ability to meet the loan obligations. The next financial statement is balance sheet. A balance sheet is a financial statement that shows the financial position of a business on a specific date, usually at the end of a financial year or quarter. Let's take a sample balance sheet for your ready reference. The balance sheet shows the assets owned by a company. These are all the resources or assets that the business controls and uses to earn money. It also shows what it owes, mentioned in the liabilities side. These are the obligations or amounts payable to outsiders like lenders, suppliers, etc. Further, it shows what belongs to the owners, that is, the shareholders, shown in the top section of the liabilities side. This is the owner's claim on the business, also called owner's equity or shareholders' funds. It represents what is left after paying all the liabilities. The basic formula of a balance sheet is assets is equal to liabilities plus owner's equity. A company with rising debt but flat profits may face solvency risk. Balance sheets reveal long-term stability, something income statements cannot. Once the balance sheet is checked, analysts review the key ratios. Let's find out some of the important key ratios from our sample balance sheet. The first one we look at here is current ratio, which is equal to current assets divided by current liabilities. Now, what are the current assets? Current assets include inventory, debtors, bank balance, and prepaid expenses. So after adding all these numbers from the sample balance sheet, we get a figure of 4,80,000. Now the next question is, what are current liabilities? Current liabilities from the balance sheet we have can be obtained by adding creditors, short-term loan, and outstanding expenses. After putting all the numbers from the sample balance sheet, we get the figure as 2 lakhs. Thus, current ratio is equal to 4,80,000 divided by 2 lakhs, which is equal to 2.4 divided by 1. Thus, the company has 2.40 rupees in current assets for every 1 rupee of current liability, which shows a good liquidity position. Next one is quick ratio, also called the acid test ratio. Now, what is quick ratio? Quick ratio is equal to quick assets divided by current liabilities. From the previous slide, we have already obtained the current liabilities. Now we have to find out the figure for quick assets. Quick assets is equal to current assets minus inventory minus prepaid expenses. These are those assets which can be liquidated the fastest. By putting the numbers of current assets, inventory and prepaid expenses in the current formula, we will get a figure of 2,30,000. Thus, quick ratio is equal to 2,30,000 divided by 2 lakhs, which is equal to 1.15. Thus, the company has 1.15 rupees of immediate liquid assets for every 1 rupee of short-term liability, which is a comfortable position. Next one we understand here is the debt to equity ratio, which is equal to total debt by shareholders' funds. Total debt is equal to long-term loan plus short-term loan. which is equal to 2,70,000. And the shareholders' funds is equal to share capital plus reserves. From the balance sheet we have, this figure works out to 5 lakhs plus 1 lakh, which is equal to rupees 6 lakhs. Thus, the debt to equity ratio will be 2,70,000 divided by 6 lakhs, which is equal to 0.45. Thus, the company uses 0.45 rupees of debt for every 1 rupee of equity, which implies low risk and financial stability. Now comes the most critical one, the cash flow statement. A cash flow statement shows how cash comes in and goes out of a business during a specific period. It explains where the money actually moved, unlike the profit and loss account, which shows profit, not cash. This statement shows the cash flow generation from 3 types of activities. Number 1, operating activities. Number 2, investing activities. And number 3, financing activities. Operating activities include cash from normal business operations. Investing activities include cash from buying or selling assets or investments. And then finally, financing activities include cash from raising or repaying capital or loans. Many companies show profits but struggle with cash. There are several important ratios that finance analysts calculate from the cash flow statement. These ratios show how efficiently a company generates and uses cash, and they complement the ratios from the balance sheet and profit and loss account. In case you want to learn those ratios in depth, please mention in the comment section. I will take up those in a separate video. Hope you have understood everything that we discussed today. With this, we come to the end of this video. If you find this video useful, please like the same and share it with your friends. Also, subscribe to my channel for many such interesting videos in future. Thanks for watching.